Welcome back to A Bite from the Money Sandwich, where we provide practical and easy to understand tips and ideas on how to manage your money better so as to let you retire with comfort and on your own terms. We all want a comfortable retirement and want our money to work harder for us. However, a lot of us don't want to take the risk when it comes to our investments in superannuation. But is staying conservative causing more harm than taking on some risk? Today, I am fortunate enough to speak to Jody Fitzgerald, who is Head of Institutional Portfolio Management and Solutions at Morningstar. Jody speaks about the power of diversity in an investment portfolio and how shares, both Australian and international, and our superannuation can help us reach the retirement with our money working harder and longer for us. I should add that any of the topics raised here today is general information only and not advice, and should not be acted upon as we don't understand your personal circumstances and how it could affect your own situation. Well, welcome, Jody, and thanks for joining our podcast.
Not a problem at all, Marc. Good to be here.
Interesting, your career choice, I should say. I've got two daughters, both very good at maths, and I always thought one of them would go into the share market or that something along those lines. Was there actually a reason this headed you into this direction?
I think, life's usually full of happy coincidences, really, more than anything, rather than well-laid plans. I think if I go back to school, I was, economics and maths were things that I really enjoyed and was really good at. And that led me down the path of doing a double degree of economics and finance. And from there, it was just a series of, different roles and different opportunities that would actually surface that led me to go down the path of, wanting to be involved in investment markets. I love investing. It does involve, as you say, a lot of maths, and we operate in a world of uncertainty. So understanding probabilities is really important. But, what I really enjoy about it is that I know that the work we do is building wealth for our clients, so that they can sort of enjoy the life that they want to live.
And I think, and we will definitely touch on about retirement and living the life they want to live. But I should actually start when you're talking about shares and getting into that side of it. Often I'd have a client come in and I even heard this from my own mum, that, shares are just too risky. You should only invest in property. So how do you combat that?
Yeah, I love that you should only be invested in property because that's risk-free. Brilliant. Yeah, look, I think it's really important to understand, if you want to generate wealth, having shares in your portfolio is an important part of that. And if we just think about it in simple terms, the reason for that is that the type of return that you can earn from shares, let's call it 8% per annum on average. Sometimes it's a lot less, sometimes it's a lot more. But really, it's the beauty of compounding and what it actually does to grow your wealth. So if you think about it from this perspective, let's just say that you put $100 into the share market today and then don't look at it again for 20 years. And that the share market on average gives you 8% every year for those 20 years. That $100 turns into $466 by doing nothing other than putting it in there and not touching it. So it's basically really important for wealth generation. The other reason why it's important to have shares in your portfolio, not simply just property or the other things that people tend to love from certain generations, particularly the older generations. I know my parents' generation would be the same. It is diversification, right? Yes, every asset has risk associated with it, but they have different risks. So it's really important that everything that you've got that you're holding to try to generate wealth will behave differently in different market environments and will give you different risks and different exposures and allow that diversification to really come through. There's actually a phrase in investment markets that diversification is really the only free lunch that you actually get in investing. So having diversification, what that basically means is having diversification means that you can actually improve your return outcome without actually necessarily taking on more risk. You reduce your risk.
Yeah, and I think diversification is an important point because at least with shares, with a low amount of money, you could be across industry, commercial, banks, communications, and have that diversity. But I also, when I talk to clients and say, the same with property. It's not as saying that not having diversification is not having a property as well. That's also good diversification. But I do see people say, well, I've got 4 properties. I said, well, yeah, but it's all in the one area. It's all in property. And the problem is that I find when you are all in one area, whether there's even just shares or property, for property, it's trying to cash in if there's ever an emergency. And we've been really, the last 12 months have shown that, needing access, and shares do that.
Yeah, you get liquidity, and that's something that you, as you say, you don't get from holding property investments. And typically, when you want the money and when you need it, it's probably going to be the worst time to try to liquidate as well.
Yeah. And for Morningstar, I enjoy hearing. I've heard you talk many a time, and you talk about value. And it's like, buying the worst house in the best street, or seeing that New Year's bargain is providing good value. You sort of have a similar way when you look at shares or the Morningstar philosophy.
Yeah, absolutely. Look, if I was to say, if someone said to me, what's value investing? Basically, we're trying to buy $1 worth of assets for 50 cents. As simple as that. Obviously, it's easier said than done, right, in reality. But from our perspective, what's really important when you're investing in shares is making sure that you're buying something that's cheap, that's currently trading at a price and less than its worth. That is how you're going to generate the returns from those particular investments. There's another style of investing out there called growth investing, which is where people are predominantly focused on, can this thing grow, like bigger and bigger and bigger and bigger. Now, that's hard to actually sort of really get an understanding of, because what you're trying to do is predict the future there. You're trying to predict, let's take something like Amazon, for example, which is a typical growth company. Can Amazon continue to double in size for the next 5, 6, 7, 8 years? Who knows, right? Who knows? But what I can do as a value investor is look at a company, whether it be Amazon or anything else, and say, well, what are the cash flows that company earns? And if I was to pay the current share price, would that make sense given the cash flows it generates? And I often say to people, think about it like the corner shop, right? Your corner shop goes up for sale and you go and have a look at it. And the first thing you do is you look at the books and you say, right, how much money does it bring in every week? And then from that, you can make a determination of how much to actually pay to buy that corner shop. Now, what you're going to pay, the price that you're going to want to pay for that corner shop is less than the value of the cash flows it generates. Knowing that there's going to be some risk because you're going to be a new owner, anything could change, etc. You're not going to go and buy that corner shop at 10, 20, 30 times the cash flows that it can actually reasonably generate. Doesn't make sense. So, but unfortunately, when people look at the stock market, they often get sucked in by the hype associated with some sort of thematic or some sort of, the internet's here to change the world. If you think back to the tech boom, bust and boom, that was what that was all about. The internet did change the world, absolutely, but that doesn't mean you needed to pay the price for some of those shares that they were trading at. Right? So a value investor is really at the heart and soul saying, what's something worth? And I want to pay a price that's less than what it's truly worth, knowing that then I'll eventually get the upside associated with that. And
I think it's right. The internet was important. That time was very important. And there were some amazing companies that came out of it, the Microsoft, the Apples, the Amazon. But there was a lot of failures. There was a lot of people lost a lot of money. And going to maybe one of your favorite topics, going to what I think is very topical right now is Bitcoin.
Yeah.
And really, if we're talking about that tech boom, there will be people who will do well out of Bitcoin. There just will. There's in any of this type of thing. But is that still a reason to invest for the majority?
No, look, absolutely not. I know you heard me speak at a conference recently where I sort of made the joke that crypto is really more of a religion than an asset class because it really is faith-based. So, and as you say, like the tech, the technology underlying cryptocurrency is called blockchain. So I don't know how much people sort of understand about that, but blockchain as a technology, is certainly going to be very important technology, and it is going to change a lot of things with regards to our society and the way that we actually operate. But, there's a big difference between the underlying technology of blockchain and the importance that it will actually play, and also the concept that we may be moving eventually to a different currency system. So not a currency system where we physically hand over dollars and cents, but rather it is, crypto in nature or online in nature. But that doesn't actually mean that price action associated with crypto can't go into bubble territory. Okay, so you've got to ask yourself a question: is crypto a store of value? Well, not really, I would say, because at this point in time, it's not really accepted as a currency. You can't go into any store and just use, Bitcoin or Doge or whatever your cryptocurrency that you happen to enjoy is to actually buy your goods and services.
Sorry, you did say bubble territory. Probably need to expand on that. Yes.
Bubble territory means basically, where people are completely overpaying for an asset. So if you know an asset's worth $1, but you're willing to pay $100 for it, well, that's just ridiculous. But that's exactly what's happening at this point in time, right? So the reason why I say it's like religion, it's faith-based, because people have faith in the fact that at some point, cryptocurrency probably will be the dominant type of currency used in markets, okay? Right. But that doesn't necessarily mean you should be overpaying for it. And it doesn't necessarily mean that the cryptocurrencies that are out there now are going to be the dominant ones. And why I think regulation is another important element to consider here is that the politics start to sort of come into play when we talk about religion and politics associated with cryptocurrency, is that we need to think about what's coming down the pipes from governments. Governments themselves know that moving to crypto-based currencies is going to be important. So globally, central banks are going to develop these. So who's going to be the last man standing? Is it going to be actually the cryptocurrencies which are backed by governments versus the cryptocurrencies that aren't actually backed by anything other than some sort of, mining sort of, element that's occurring in the background? So when I go back to the concept of the bubble territory, you have a look at some of these, the price action that you see in some of these currencies, right? And a really good example is when Elon Musk went on Saturday Night Live and, started talking about Doge, and it was down 36% overnight. That's not, that asset is clearly not trading at a sensible price or at a price that it's worth if it can move 36% in a day. It just, it doesn't make sense. So, my basic rule for investing is that if you can't understand it, don't invest in it.
Yeah, no, makes sense actually. And but also you actually mentioned about Amazon, and one of the things I like about that, but we've never really had the opportunity when I've been for 30 years in helping clients invest, was access overseas shares. And that's one of the things I actually do like about Morningstar is that international feel. You probably have more international shares than Australian shares. And when you're talking about Amazon, that's a perfect example of access that you would have that we wouldn't have had 10 years ago to be able to invest in. So probably getting your view on why having, apart from, say, diversification, strong international shares, not just Australian shares, which is for most of us mum and dads, we only ever invested in the mum and dad type Australian shares, Telstra's, the banks and so on.
Yeah, and I think there's a behavioural bias behind that, right? Is that as Australians and somebody who, if you're not in share markets and don't really understand them, there's a comfort in I can buy Westpac shares and I walk past the Westpac bank, so I know what that company is. I know what Coles is. I know what all these listed Australian companies are because I interact with them on a fairly regular basis. And going offshore just feels a little bit less familiar because you don't feel like you have that home territory. But the reality is, though, when you actually have a look at global equity markets and put Australia in the context of the rest of the world, Australia actually only represents 2% of the global equity market. So it doesn't really make sense that you put all of your wealth in only 2% of the market. Like you're missing out on a lot of opportunities. Plus, on top of that, the Australian market is hugely concentrated. So we are basically a market of banks and mines. Effectively, it's half the market. Half the market is a handful of mines and a couple of four big banks, effectively. So going global actually gives you access to other sectors that aren't dominant here, things like healthcare, tech, etc. And just because of the age of the internet, a lot of these companies are becoming global household names. So everyone knows who Amazon is. Everyone knows who Google is. Not necessarily saying that they're the best stocks to be in at the moment, because we actually do think they're very expensive at this point in time. But people know the names of these companies. Things that we really like at the moment are energy companies, but they're things like BP. Everyone knows who BP is. Just happens to be listed, offshore in the UK.
And I suppose that sort of leads into, if you don't want to actually buy shares directly, managed funds is the best way of doing that. Where everyone has a superannuation fund, they're probably majority sitting in managed funds. For me, managed funds are just great because they just provide someone else who's looking after picking the choice, doing the research, picking the shares. You still have access, you're still pretty well having ownership of those shares, but it's all in one pooled managed fund. So from your point of view, that's the easiest, most efficient way?
Look, I do think it is. Investing's a full-time job.
Yeah.
That's why I've got a job, right? So there's a lot of work and a lot of effort that actually goes into, pulling apart and getting an understanding of what is an investment really worth and what should I pay for it? And how can I ensure that when I buy this investment, I'm going to generate returns for clients and so forth. And, I know that there sometimes is a love affair with actually doing some of this stuff yourself. But as you say, it leads to some of those biases that we see in behaviour, that people will tend to buy something that they know, as opposed to, should I buy that because it's a good investment?
Yeah.
I'm going to buy this stock because I know that company. I walk past it every day on my way to work, when we used to walk to work and be able to get out of our houses. Versus actually this company, sitting over in France somewhere or in the UK or the US, don't know anything about it, but actually could be a really cheap, great investment, generating cash flow with lots of growth opportunity and potential for returns. Now that takes a lot of work, a lot of effort. You've also got to have an understanding of things that might impact. So what's going on in the world? What are central banks doing? What are governments doing? There's a lot of moving parts. I would say to people that, if you've got a light bulb that needs changing, yep, you can do that. But if you've got some major electrical work, you're not going to do it yourself. You bring in someone who knows what they're doing. You bring in an electrician. I would say investing is the same. There's some base level stuff that you can certainly do yourself, particularly if you do have a love and a passion for it. But with regards to ensuring that you're generating the wealth that you're going to need for your retirement, I think having it professionally invested through managed funds is important. And as you rightly point out, most people may or may not realise that they're actually holding professional investments through their superannuation.
And if we're talking about superannuation retirement, it is one of my little pet causes, is that it's a Goldilocks effect, if I want to put a name to it, in that if 80% of people in their superannuation funds, their investment is most likely the balanced fund. So not too conservative, not too risky, somewhere sitting in the middle. And that's why, the name balanced is there, but they're actually missing out on probably 2 or 3% per annum ongoing on a long-term investment. And so just giving up money. Having a high growth, say, for example, investment strategy over the long term, to me, makes sense, gets you the best potential return based on history. I suppose from being in the industry yourself, that makes perfect sense to yourself as well.
Yeah, look, it does. And I think that, the industry has a tendency to say, okay, well, how much risk can you tolerate? And then we'll take your equity exposure up to the limits of that risk. But the problem is, what's risk, right? Like, what does that actually mean? And if, as I talk to my mum and dad, I'm a country girl, working class family. If I said to mum and dad, what's risk? I know what they'd say, don't lose money.
Yes.
Or don't. So it's kind of interesting the way that portfolios get built, to sort of try to ensure that we've corralled clients into the right products. But I do agree with the comment that being in the balance and just sitting on the fence as far as risk may actually not be a wise decision for some people. And the reason for that is that, there was, if you go back sort of 10, 15 years ago, there was a fairly standard rule of thumb that as you retire, you de-risk your portfolio and you go into conservative investments. However, what we do know is that we are living longer and longer. And retirement, so when the superannuation system was actually first devised, the average, when you look at longevity rates in Australia, the average period for retirement was only 12 and a half years, based on sort of longevity tables and on average when people would actually die. Longevity rates are actually increasing by about a year to 2 years every few years. So we're getting older and older and older and older. So de-risking your portfolio when retirement's a 10 to 12 year proposition, that probably makes sense. But based on current longevity tables, retirement is actually about a 25 to 30 year proposition. So if you de-risk your portfolio and put yourself where, as you say, balance, let's just call balance, just for simplicity, a 50-50 portfolio, right? It's really balanced, 50% equities, 50% cash and bonds. You are going to be giving up substantial opportunity to earn returns in equity markets. And yes, equity markets are more volatile and do carry more risk. However, when your time horizon is 20 to 30 years, that risk gets lower. Risk is higher in short term because shorter term, the volatility looks big, but over time, capital market volatility tends to sort of reduce down. So, I would also say, when you're thinking about retirement, risk really should be the risk that you can't live the life you want to live, that you don't have enough money to actually afford the lifestyle that you want. Now, if retirement is a 30-year proposition, you are going to have to make sure you're generating enough wealth to keep the lifestyle that you actually want. So having extra money in more growth assets will be important. That said, though, if you're one of the fortunate few who are retiring with significant assets and you're definitely self-funded and you've definitely got enough money to live the lifestyle you want, de-risking does make sense. You should absolutely de-risk once you actually have enough assets to live the life that you want to live. But keeping in mind, that could be a 30-year proposition.
Yeah, you've actually made some really good points there. People are living longer. There's no question about that. One stat I do remember right from when I first joined this industry was that in 1904, when the government set that the retirement age was 65, the average life expectancy was 57. So they weren't really expecting a lot of people, but we've kept that age 65, and it's only just recently moved to 67. So that makes sense, and we are living longer. The other point you make that I was talking about is the risk. And we do get this wrong, I do agree, in that people look at it as the risk of, the share market dropping rather than the risk that we're going to live longer. And it's education. I think, anyone doing a risk profile on a particular client saying, what is the risk, should actually have probably an hour worth of education before they do that, because if you have a 5-point question from most conservative to the most risky, 9 out of 10, you're just going to go the middle option. It's human nature, and unless you're taught differently. And so risk is important, but education probably is even more. Okay, so one of the things that I am interested in knowing, because Morningstar is a company that actually does have a large international exposure, we're seeing more about ESG type investing, ethical type, socially responsible type investing. And when I first started, trying to pick a company that didn't have cigarette advertising or cigarette companies was the best you could do for an ethical type of investment. So we've gone a long way since then. But they're also very expensive. That seems to have all changed now. They're getting better returns. And there was an article in the Financial Review that said there's nearly $1 trillion now invested in ethical type investments. How is yourself or Morningstar looking at that side of it?
Yeah, it's an area where we're continuing to do work. I think it's really important to sort of understand the spectrum that's available within this space. So the form that we currently do within our portfolios is referred to as integration, so ESG integration. What that means is that we don't exclude things. We don't say, okay, you're an alcohol or a gambling company, you're out. What we will do is we'll actually, when we're making an assessment of what is this asset truly worth, we'll think through and penalise assets that may run into issues associated with ESG. They may be subject to further regulation because they're in an industry that's considered undesirable, or they might have, we might be concerned about any environmental issues that might arise and have people turn away from those particular investments. So the hurdle to get into the portfolio is higher for anything that might have sort of an ESG type impact effectively. Right. However, if the returns still with that higher hurdle are there, we will invest. So that's what ESG integration is. And I would say that most asset management firms now do that. The next level down then is, what's typically important is that quite often why people go down the ESG route is they want to change society, right? They want to change what happens in the world. Sometimes the best way to actually change it is to be a shareholder and be an active shareholder. So the next level down is then basically, as a shareholder in a company, can you actually do proxy voting and all the different bits and pieces with the company and shareholder activism to get the company to actually change the way that they do things, for example. Now, that's really tricky for an individual investor, but for larger institutions like ourselves, we can certainly do those engagement practices where we can actually, and Morningstar owns a business called Sustainalytics, and that is one of the things that they'll actually do is go out and sort of, be actively involved in trying to shift the way businesses are operating to ensure that they're more ESG friendly. The next level across from that is then the negative investment screens. Now, this is a real minefield because what's ethical to me might not be ethical to you or to somebody else. So that's the hard thing with these products in the marketplace, is that there is no one size fits all. So you kind of have to look around and work out, okay, so this product will screen out these sorts of sectors. And these are the sectors that I dislike the most. So that one's okay for me. But there'll be other people who want to take it. So the question becomes, let's take something like gambling, right? So that's pretty easy to pick a casino and say, well, that's out. That's obvious, right? Because that's its main industry. But what about, and it's not the case now, but Woolworths, a number of years ago, used to be the second largest owner of poker machines in Australia. It's not their primary business, but it was a major business. So would that have been out? Would you exclude banks who have lent money to Crown to do development? So how far down do you go? Does it have to be the primary industry? Do they have to generate some revenue from that industry? So there's lots of depth to that ESG question. And that third element is what we're looking at the moment, is trying to understand, could we build a capability that would resonate with the vast majority of people? We know we're not going to have a solution for everybody because everyone has different shades of green, I guess. But those first two elements being ESG integration, making sure that if something is going to be subject to ESG risk, that it has a much higher hurdle to get in the portfolio. And the next one being an active shareholder. The other thing I'd point out with ESG as well is sometimes it's important to understand the evolution and not to throw the baby out with the bathwater. And a really good example of that is energy. So energy is one of the positions that we hold in our portfolio at the moment. And I get a lot of questions on ESG and energy and, carbon footprint. There's no doubt that we're going to a more carbon neutral world and society. But what you need to remember is that these big energy companies are actually going to be a part of the solution. And you have a look at some of the European energy companies, and about a third of their R&D is actually going towards renewables. So by divesting from those businesses, you can kind of think about it for two ways. I'm divesting from them because they're a big polluter, but actually, if I'm investing in them, the money that I'm giving them is going towards R&D associated with renewables. So you can kind of take a different perspective of whether or not that is a good or a bad company to be in.
It's a fine balancing act, basically. Yeah, it's tricky. Yeah,
it's a tricky space. It's a really tricky space. Yeah, because everyone has different views. I mean, there's some obvious things that everybody tends to agree on, but how far down do you go? Does it need to be a primary industry or generate any sort of profit from it? Should it be excluded?
And just by the way, I said ESG in the beginning, and people often think it's ethical, social, and green. But it's actually ethical, social, and governance. And it's important to see how some of these companies are run. One of the reasons I was very keen to have you on this podcast and helping the education on shares as a good investment is there's not really that much else to invest in when cash is so low at the moment. Interest rates are so low. And especially when we go from COVID last year and this year, a lot of people, and there was a downturn last year, a lot of people, whenever there's a downturn, take all their money out of the shares and all that and put it into cash. And when cash is virtually less than 1%, it's just not the right way of doing it. Yeah,
and it's also trying to time that as well, right? So people get scared and they get out. So the old, what you want to do is buy an asset low and sell it high. You don't want to buy it high and sell it low, which is exactly what happens when people get scared and move to cash. Now, using the COVID sell-off as an example, it was hard. It was fast, though. It was 6 weeks from peak to trough. Like that was just the fastest downturn we've ever seen. It was kind of like a white knuckle ride, right? If you pulled your money out though, you would have missed the huge bounce that we've seen. Like markets have not only smashed through the levels that they're at pre-COVID, but they've gone well and truly bond. Like you would have earned, depending on what markets you're in, anywhere between 40 and 60% in equity markets if you're in the right spots. If you'd pulled out though, cash rates, the RBA at the moment, or the Reserve Bank of Australia, has current official cash rates at 0.1%. So, and, when you think about that, we talk about interest rates being low, and the reality is they're likely to be low for quite some time. What that means is cash, if you put cash in a bank or if you manage to get a term deposit at whatever rate, it's not going to be hugely high given cash rates is 0.1%. You're not earning much. And in fact, you're actually going backwards. If you think about it from your wealth generation, you might want to use that cash in a year's time, 3 years' time, 5 years' time. Inflation, so the general prices you pay for goods and services goes up. So at this point in time, what you're earning from your cash is less than inflation. So your spending power is actually going backwards. Now, cash is a store of wealth, right? Because you don't lose money in cash. Unlike any equity, any investment market, which can go down. Cash doesn't go down, it just sort of sits there, right? So it's a store of wealth. However, it's not going to help you generate wealth.
And one of the things I do always say about shares is absolutely, if it's only 1 or 2 years, it's gambling. But most people, especially in their superannuation and their retirement funds, and this is even when you're retired and you're now going to live off your superannuation for the next 20, 30 years, you still want it working as hard as possible for you for as long as possible. And as long as you have at least 10 years, it takes out all the ups and downs of the share market and takes out that risk factor, as we've been talking about. So I think with interest rates being so low, it's just such an important thing to understand shares. Most people understand property, especially their local area, but with superannuation being most likely your second biggest asset behind your own home, it's worth having a look at that statement and seeing where your money's invested.
Yeah, absolutely. Absolutely. And I think a good way to think about shares, if you're not familiar with them, is that you just own a little piece of a business.
Yeah.
Basically. So that business being the corner shop, being Coles, Woolies, Amazon, BP, you just own a little piece of that. So a client of ours was telling me about his young son, they have, shares in sort of Bunnings, and they went to Bunnings with their grandparents and told their grandparents to spend up big because I get some of this money.
Yep.
Because I own a piece of this business.
Oh,
and
wonderful.
I thought, what a clever way to think about it. It's just like, I've walked into this shop and I own a little piece of it. So when I'm spending money here, that's, helping the profit of my business that I own. So it's a good way to think about it, actually. It's quite a simplistic way to think about it. But yeah.
One of the things actually we just should comment on that you made a point of, that how quickly the share market dropped last year, white knuckle ride. But it was actually, for me, it was the recovery was so quick. I've had people who've told me in the past, well, if the share market drops and I take my money out, I wait 2 years and then I'll go back because it takes that long for most share markets to recover. It was back within 6 months. It was amazing how quickly it recovered this time around.
But even the GFC was the same, right?
Yes.
Is that the recovery was actually quite short as well. So like what we were doing, right, as so it was a white knuckle ride, but we were having fun, right? Because we're like, oh my God, these assets are so cheap. So we were picking up assets at 10 and 20 year lows. So we were piling money into the market. That whole buy low, sell high. It was a once in a decade opportunity to start picking up really cheap investments. And we piled in effectively. And now that markets are getting expensive, now we're starting to pull back and put more money into cash because it's getting a bit expensive. We'll just bank those returns that we've got and we'll wait for the next pullback and we'll go again. Whereas I do think that fear of, there's some, behavioral science studies around that people hate losses twice as much as they enjoy gains. So when people see losses, they're more likely to actually pull out. And, we've done a study before on this with regards to if you take a market pull down and if you go to cash and wait a year and then go back in, your wealth generation is less than half of what it would have been if you just kept your money invested.
Wow. Yeah, I think definitely in 2008, the global financial crisis, GFC, was a wake-up call, especially to the advisor market as well. A lot of advisors weren't quite sure what to do, and learning from that. This time last year, the amount of proactive commentary that were coming from advisors to their clients to make sure, don't do anything silly, let your money see this out, it will recover, even though the newspapers are saying the world's ending. And it did. It recovered within 6 months, and we've seen the benefits of that. So it is the value of actually communication during these tough times. Jody, we can keep talking for hours because you know so much, and I really just enjoy talking and listening to you. But yeah, I do need to bring it to a time. You've got homeschooling to do and all this.
Surprised I haven't been disturbed.
So one of the things we always ask anyone who's invited on our podcast is a final bite as the best piece of advice they've ever heard. What would be yours?
Best piece of advice I was ever given, and I've subsequently given it to my children, is work out what you love doing in life and then find someone to pay you to do it. And I just think, and I've said that to my kids because it really stuck with me when I was growing up. And I've said to them, I don't really care what career path you choose, whatever you want to be in life, be it, but just make sure you love it. Because then if you love it, it's never a job.
Yeah. No, very, very wise. And every time I see you, you've got a smile on your face, so you're obviously enjoying your own work. Jody, it's been a pleasure to talk to you, and thank you very much for being on our podcast.
No problem at all. Happy to be here.
As with every podcast, this information is not advice, as not personalised to your own situation, and past performance is never guaranteed for the future. What we're trying to do here is provide tips, coaching, and education to help improve your money knowledge, which we believe can only be a good thing. Thank you for listening to today's episode. If you'd like to know more about Morningstar or their work with ethical investing, visit morningstar.com. Also, feel free to either email me at admin@themoneysandwich.com or visit the website themoneysandwich.com if you have any questions or want to learn more. Also want to note that in the interview we talked about ethical investment, or ECG, and I said it stood for ethical, social and governance. I unfortunately made a mistake with this, and the E actually stands for environmental. So environmental, social and governance. Want more practical, easy to understand tips and action lists to help with your money stuff? Buy my book, The Money Sandwich. Available now on our website, themoneysandwich.com, as well as major online retailers. See you next time when we take another bite from the Money Sandwich.